Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 60. I think we can get cheaper hamburgers at Wendy's now, the AARP, right? I think that's how that works. Episode 60 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're titling this one, Why the Fed is Done. Just a little bit ago, we had some inflation data. You and I have been in that camp. If you listen to this very podcast, you know we've been saying for a while the Fed is done, but now it's the nail in the coffin, so to speak. So, Sonu, I will say this. So if you're watching the YouTube channel, it's very clear I'm in a hotel room. So I'm not in a regular spot. I'm out in Spokane. Yeah, I'm out in Spokane, Washington. So here's the thing about Spokane, Washington. I was here yesterday also, here today, meeting with some of our partners and some of their clients and some client events. And it was like 4:15 in the afternoon yesterday. It was like pitch black. I looked outside. I was like, what is going on? Because the time changed and everything. I was all mixed up. It was like dark at 4:15. I said, oh my goodness, that is depressing. I live in Ohio.
Could you see the Arctic lights? Could you see the Arctic lights out there?
No, I didn't see those. I didn't look necessarily either, I guess, but I just was shocked at how dark. What time does Chicago get dark now with the hour change?
Probably about 6 o'clock, thereabouts.
So what's that noise? We got some noise going on. Is that you ringing? What is that? This is the joys. I always tell Sonu, turn everything off and then look what happens, you know? Yeah. Who's trying to get a hold of you?
You know what?
What is it? You even allowed to talk about it? Is it private?
I have no. I think it was Jessica trying to call me about something.
Oh, so. You didn't turn Teams off. You didn't turn your Teams off. See, I gotta check.
Yeah, I was looking at my phone. I was looking at my computer. I have like 4 screens, and I'm like, I have Bloomberg up. I have Facts set up. I have this thing up, and it's wild. My computer is ready to drown.
I was gonna say, it's too much going on there. So let's just get into it, right? We're titling episode 60, why the Fed is done. We're gonna take a look again at this morning's inflation data on CPI, which came back or came in lower than expected. Again, likely suggests the Fed is done. We're also gonna take a look at the year-end rally. We've been expecting a year-end rally. Hey, stocks have been doing that. We're gonna talk about kind of where that stands, and then maybe finish things up with maybe a smorgasbord, whatever we want to talk about. But I do want to touch gently on the downgrade that apparently happened. That literally nobody even if a downgrade happens in the woods and no one sees it, does it really count? Does it really happen? I think is what we're going to talk about. But let's just go, Sonu, get into it. The CPI number, I'll be very honest, I saw the headlines. I haven't looked into it too much, but I know you've been looking into it. Futures are soaring at least Tuesday morning on what again was a little bit I guess I'll call it better than expected. If you like lower inflation, better than expected CPI print. You want to take it away and what you found as you've had a chance to dive into that.
I love how you say, like, if you like that sort of thing, lower inflation, hopefully everybody likes it. But that could be a double-edged sword sometimes, right? So,
true.
Lower inflation could be, a sign of deflation, all of that. But, we're not in that situation right now. No, this October, this is the Consumer Price Index report, the CPI report. It was, goodness, chock full of good news. I mean, across the board, Ryan, headline inflation was flat in October. Right? Expectations were for a 0.1% increase. I'm just looking at my notes.
Yeah.
So we got an October surprise, right? That was the October surprise. Now it came in November. But it was on the back of gasoline prices, right? We know, you and I have been talking about this. Gasoline prices have been heading down. It was nationwide average gas prices were about, 3.9, 390 a gallon. That's down below 340 a gallon. So that's fed into the CPI report. Headline inflation is now down to 3.2%. Remember when it was 9% last year? So we've come a long way, and a lot of it is gas prices, right? And that the fact that gas prices are declining is also good for consumers, because that means inflation-adjusted incomes are rising. There's more money in people's wallets, household wallets, to go spend, and that's good for the economy, right? But then you think about, okay, that's the economic piece of it. Go ahead, Ryan.
Well, I was going to say it's good for bulls because on the YouTube channel you do have your both horns are up. I think we put one horn
Yes.
down for a while there. It's a
Yeah,
two-horn
that is.
bull market now as we continue to break above 4,400 on the S&P 500. And also, I'll say this much: I heard this last night. I didn't know this. Again, I'm in Washington State right now. Apparently, gas like California and Washington State are two of the most expensive. So I'm up there in front of a lot of clients, and hey, it's cheaper to fill up your car. They're like, not here, it isn't. I said, well, you know what? Sorry, maybe the other 49 states is cheaper, but apparently Washington State is still very expensive. But I did fill up my car the other day. It was the cheapest I've done in a while. And hey, we said before, consumer confidence and oil tend to be inversely related. When I paid $15 less than I was paying a couple months ago, that felt pretty good. Go ahead, Sonu.
No, exactly. And so that's that's the point about how inflation impacts, the real economy, impacts all of us, right? It's mostly through gas prices. And that's the good news, right? Now, the Fed strips out, as you know, food and energy, right? Because they're like, that's too volatile. So we need to look at quote unquote core inflation. Now, core inflation was just up 0.2% in October. That's if you annualize it's like 2.8%, right? Over the last 6 months, Ryan, core CPI has run at 3.2%. A year ago, we were looking at 6 to 7% for core inflation, core CPI. And so we're getting ever so close to that Fed's 2% target. And remember, even before the pandemic, 2019, right? All the way through February of 2020, core CPI was running about 2.3%, right? So the good news from that CPI report is that, yes, headline inflation is lower on the back of gas prices, but we're seeing broad disinflation across several big categories as well.
So I'm sorry to jump in. I was just checking some things on my phone. Without looking, do you know how much the Russell 2000's up as we speak? Can you take a guess? Have you seen this?
I did see it. It's about 3.5%, 4%. I
oh my goodness, it's up 4%. Russell, and again, I know this might change by the time listeners hear this. The Russell 2000. You talk about who likes this morning's numbers. This is the real world stuff, right? We're talking, okay, lower inflation. Small caps absolutely love this, and we've talked for a while. We're gently overweight, small and mid caps, and again, it's been a rough go. We thought, hey, it'd be likely to see, because honestly, the next 3-4 months historically when small caps do well, and so you got the calendar lit, you got the fact that everybody hates small caps and mid caps because they have done poorly. But again, now with inflation coming back, my goodness gracious, that is, I had to look at my phone 3 times. It's okay, it's really up 3.8% the first hour or so of trading. Wow.
Yeah, I was going to, exactly. See, that's what potential rate cuts. Ryan, we're not talking about this inflation report basically putting a nail in the coffin of further rate hikes. We are going to talk seriously about rate cuts in the first 6 months of 2024. Because look, if inflation comes down to 2.5%, right, 2.5%, 3%, and the Fed's at 5.5%, the Fed funds rate, that means policy is getting tighter. They don't want to do that. They don't want, Powell said, we don't want to break the labor market unnecessarily, right? So I think that's with good reason. I mean, everyone's pricing in rate cuts now.
Yeah, and next year is an election year. And I know the Washington and the Fed are supposed to be separate entities. Are they? Are they not? I'm not going down that rabbit hole. But do you really want to break the economy as we head into an election? No. I'm going to say probably not, okay? The president does pick who's in charge of the Fed. He might not like it too much if you go and do something like that. But again, this idea of a soft landing. I saw some headlines the other day, Sonu, like yesterday actually, that maybe there's going to be a no landing in 2024. I'm like, well, that sounds really familiar, right? We were saying no landing a year ago. And it's funny, at this event I was at, they were talking about how 50% of economists now expect a recession in the next 12 months. I got up there and said, listen, a year ago I was in front of you. Well, that was a random number that someone threw out there. Who knows what survey it is. But I said a year ago, that was darn closer to 100% of economists. Remember that Bloomberg? They've got the proprietary data. It said 100% chance of a recession. I think it was October 17th within 1 year. Clearly it didn't play out. So we're hearing a lot of the same things. And now we've got the market. And I'm kind of combining these two because we talked about the Fed, but I'll just kind of combine our two to part about the bull market rally. One of the problems the last couple of weeks participation. Yes, we had a market that's rallying. Last week we had a big rally, but everybody said, look at this. A lot of stocks didn't participate. And you know why? Because small and mid caps didn't participate. We'll see what happens Tuesday, but I'm going to take a wild guess that if things finish up kind of where we are now, so we're going to have a massive change in that participation that everyone keeps knocking. And we've been saying, it's probably still bullish because we're going to eventually get that participation, and it's taken place. Let's go back to the hit rewind again, kind of combining the first two subjects. Hit rewind, Sonu.
Good.
Back on the Fed. I mean, what else do you want to say? I mean, the inflation is really coming back. The Fed's probably done. How does it all matter again? Let's keep diving into this for the listeners because I think it's such an important concept.
Inflation's so important because, the Fed has said, Powell, even recently, a few weeks ago, he was talking about, yes, inflation's come down. That's welcome, obviously. We just talked about inflation coming from 9% to about 3.5%, right? But he said, a lot of that has come from improvement in supply chains, right? We saw new vehicle prices come down, used car prices come down, and then housing too. Housing disinflation is happening. We know rents are coming down. So that's going to feed into official data. So all of this is known, right? What he was, he thinks, but the last mile of inflation, getting from 3% to 2%, that's going to be hard. That's for that, the unemployment rate may have to go up a little bit. The economy has to slow down. Hey, guess what? Over the last year, we've seen, inflation slowing even in those categories. They call it like core services excluding housing, right? So this is stuff like hotel accommodations, live entertainment, dry cleaning, things like that.
Let me make sure. Sam Rowe, friend of the show. Sam's been on the show twice. We've had Libby on twice. We've had Sam. Are they the only two that we've had on twice? I think.
I think so.
So Sam Rowe pointed out, I want to make sure I say this right, everybody. So I think he said apples, which Sam kind of finds funny stuff. He said apples are down like 7% or something last month. I think that's what he said. There it is. Listen, women's outwear down 5.9%, apples down 7.9%, uncooked beef roast, typical Sam being kind of funny, but again, that's up 4.1%, but pork chops are up 3.5% also. But nonetheless, apples down almost 8%. Now, believe me, maybe there's some Apple thing happening out there, but just overall, hey, it's cheaper to buy apples. Everybody and their mother has been saying, well, go to the grocery store, it costs more. Yes, we're not minimizing that. It does cost more. Then they go get in their $80,000 car and take their $15,000 trip to Europe. And, people are complaining about the grocery store, but then they're still out there spending and consuming. So we're not minimizing it costs more to go to the grocery store than a year ago. But again, people are worth more. We talked about that before. Incomes are still strong and real incomes are hitting all-time records. Again, as incomes are growing faster than inflation. Those are some things you don't always hear when you watch your nightly news.
One more thing for me, Sonny. Ryan, are you an Apple guy?
Go ahead.
Are you an Apple guy?
No. I'm an Android guy. You know that. I'm an Android guy. Oh, you meant eating apples. So no, I like oranges. I get those little you didn't see that coming in. Those little mandarin oranges, cuties. They're called cuties. I love those. I love those little cuties. I eat a lot of those. Those are good. They're easy to eat. No, so don't do a lot of apples. But I like oranges. Oranges.
I'm not a big apples.
I love strawberries.
Yep.
Yeah.
I was just
I like apple pie. I like apple pie. Give me a hot dish, nice toasted apple pie with the sauce on top and the ice cream. Oh boy, that's I can do that one. So I don't even know what I was talking about. You sidetracked me when it came to the apples discussion. Oh, you asked me like apples. I made a joke about I'm a Google guy or Android guy. Anyway, so I'm not sure where we're going with this, but I will say this: we talked before about pet prices coming down, right? Did you see that by chance in there? Did you get a chance to look? I mean,
I can look.
So
right
again, I have a new dog and everything, spending money. This is crazy. Did you see the headline in Wall Street Journal yesterday, Sonu?
What
you know what I'm going to point out here? Sorry. What I'm going to point out is this. Give me 1 second. There's a Wall Street Journal article. There's a pet psychic, and here's the title. Charges $550 for 90 minutes and has a list of 7,600 people. So there's someone as a pet psychic out there. Wow. Charging a lot of money, and a lot of people are paying it. You got to think if Jerome Powell sees that, he's like, okay, I'm not done yet. Jerome Powell's like, I haven't broke the system yet if we've got pet psychics out there making more than just about everybody else out there. But anyway, I don't even know where to take that one. It's an interesting world we live in.
Pet services are down. Yeah. Prices for pet services are down last month, about 0.4%.
Yeah.
Over the last 6 months, they're flat. So, maybe it's time for another dog, Ryan.
Well,
what do you think? Are you done with
Oh no,
You
no,
know,
no. It's we'll stick with so Walter's 140-pound Great Pyrenees. Now we have Mabel. So Walter, Mabel, kind of older-ish names. My wife likes that. When we got Mabel back in September, she was 18 pounds. She's almost 50 pounds down. Not a shock, right? I mean, that's inflation in terms of my dog growing, and she's probably going to double again and then double again. So we'll see. She's a sweet girl, but she's still a puppy and she's crazy. So anyway, all right. So Sonu, let's kind of wrap this up on the Fed discussion and interest, Fed and inflation, what I'm trying to say, or interest rates, whichever one to take it. Maybe let's go that route. As I talk out loud, this is how the sausage is made on this show. We just kind of wing it and talk about whatever we want to talk about. If the Fed is done, which it sure looks like, what if they cut next year? I mean, I haven't looked at Fed fund futures. Now I saw some headlines. Oh, the Fed might cut now. You have been saying the Fed might cut for several months now, okay? And now the market's seeing it, and now small caps and mid caps are flying, saying, oh, maybe the Fed is going to cut. When do you think they might cut? And again, remind the listeners, last few times the Fed cut, a 100-year pandemic, the tech bubble, they cut, what is the other one?
And 2008.
Tech bubble, financial crisis, financial crisis. The Fed has cut before. It's been really bad, okay? Yes. Why is the market excited they might cut if it's so bad when they cut before? Explain that to me.
Short answer, soft landing. Basically, the economy is growing, but inflation's falling, and they don't want to keep, like I said, they don't want to push the economy into an unnecessary recession, right? And so they'll cut because otherwise, look, if inflation's running, like I said, at 2.5%, they're at 5.5%, that was, keeping rates at 5.5% and inflation's running at 4.5%, 5%. Yeah, that makes sense, right? They want policy to be so-called tight. But if inflation pulls back below 3%, like, wait a minute, why are you guys at 5.5%? That's why markets are right now pricing in about 2 rate cuts, 2.25% rate cuts over the first 6 months of next year, right? And I think I'd fall into that camp too. I mean, especially if inflation goes the way we expect it to. And that's the other part of this report, right? This
if you
report
fall,
doesn't point to surprises.
if you fall, just be careful. If you fall, be careful, Sonu. I don't want you to get hurt if you fall there.
No, like I was saying, the good part about this October CPI report is, you're always worried about a shock, and those things can happen. That happened after Russia's invasion of Ukraine. Energy prices went up, things like that, right? But for the most part, like you say, okay, set aside the shock. What else is in the data that can lead to higher inflation over the next 6 months? Right now, Ryan, nothing. I don't see anything in there that could potentially send inflation higher over the next 6 to 9 months, and which means we are in line for rate cuts. I mean, I'm in that camp.
Yeah, there you go. Okay, so and you've been in that camp for a while, and there were not many people that were saying there's no recession coming. Oh, by the way, the Fed might cut next year, and that's going to be a bullish event. I mean, honestly, I can't think of too many people that were saying that. You've been on that camp. Now, I do want to point out something that I saw earlier, and it's really fascinating. Data from FactSet, but I get this from Blake Millard. Big fan of Blake. He's the Sandbox Daily. You can sign up for his daily email. I'd recommend it. Blake's awesome. And he had this chart, again, from FactSet, but Blake does a great job just kind of finding what's interesting out there. And it kind of puts into context why small caps are soaring right now. Because if interest rates are going lower, the Fed's going to start cutting. That's why small and mid caps have done well. And here's why. According to this data from FactSet, thanks to Blake, floating rate debt versus fixed rate debt. If you look at let's start with the S&P 500. S&P 500, as of the end of last year, fixed rate debt, 91% of debt was fixed. 91% of debt was fixed. In other words, companies like Microsoft and Apple, all those companies finance things really, really low. That's why higher interest rates haven't hurt them as much, which means about 9%. Yes, they locked down really cheap debt. And anyway, so about 9% floating, right? That'd be the rest, right? It has that up to 100. Here's why this all matters. Russell 2000. Fixed debt as of the end of last year, 51%, which meant 49% was floating. When interest rates continue to go higher, that is why small caps have been hurt so much. We've talked about this before, but I just think this is really good, some data behind it. And now that we have a Fed that's likely to, again, the title of this week's podcast, Why the Fed is Done. And as you and I were talking about this, I'm agreeing even with it more now as we talk about it out loud, that if there are cuts coming, That's why small caps and mid caps really look like a nice area to be overweight, which we've been overweight for a while. It's been painful, yes, but as we head into next year with a likely soft landing or no landing, there's an economy that keeps surprising to the upside with record earnings, with inflation coming back, with high productivity. It all in all adds up pretty good. Now, one final thing on this is we probably should move forward. We took a look at the last 10 rate hiking cycles, Sonu, back to the mid 70s or so. 1 year later, after the Fed stops hiking, 1 year later, S&P's up over 14% on average, higher 8 out of 10 times. Yes, the early 80s are in there. Yes, early 2000s are in there. This isn't perfect, okay? But again, if the Fed is done, that again is a positive, we think, going out. Let's say next year or so, especially with an economy that looks pretty
July
strong.
was
what's your favorite? Maybe let's go there. Yeah,
July was the last rate hike. So
I think so. I think you're right. I think
one
it's
year,
been about 3 months, 4 months.
So still room to go up.
Yeah, exactly. Honestly, I mean, hey, we were down, and last I checked, we were down in August and September. I started the bounce and October. Sorry, down 3 months in a row, but clearly November is coming back. So I'm in a hotel room. I'm in Spokane, Washington. Nice place. I forget where I am. It's some Marriott brand hotel. It's a nice hotel, though. I woke up and my left little finger has been numb, and it's still kind of numb. I usually you sleep kind of funny or something, so I'm like, I don't know what's going on here. Hopefully, you don't want to start Googling. I don't want to start. Don't everybody listen to this and start Googling what it means my left little finger is numb. But hopefully it wakes up. I don't know. It's like, I got up like at 4 a.m. out here because I'm trying to stay on East Coast time, so maybe my finger's just not ready to move yet. The other thing, as I look at my computer, we talked about this before we started. I've got that symbol at the bottom that says your computer needs to have a restart, and I keep hitting like no, because sometimes you do that hard. The computer makes you do a restart. So hopefully, let's put it this way: if I drop off this podcast, you just keep running with it because we've talked enough. There's no need to restart things. So hopefully, I can avoid that. So let's go forward. So the Fed is likely done. Yeah. Good conversation there on inflation as well. Let's talk about this year-end rally. I mean, we've been in the camp that we're going to have a year-end rally. Yes, October was probably a little bit worse than we expected. Last week, we talked about the idea, though, early October 4th or so, were lows and the market bounced. Then we broke those lows into October 27th. The good news under the surface, less stocks were breaking down. Less stocks made new 52-week lows in late October versus early October, even though price made new lows. And that's what you tend to see at major market lows. You also see your average year, no such thing as average, I'm aware, but your average year bottoms on October 27th, and then you have a year-end rally. We bottomed on October 27th, and we are looking at a pretty significant year-end rally. So now we've got some numbers here. Give me 1 second to find this in an Excel sheet. Of course, I must have changed stuff. When you're up at least 10, here we go. Okay. When you're up, wait a minute. Where'd that go? Where did this is what happens when you do stuff live. I know I did a tweet on it too. Yeah, I don't know what's going on anymore. When you're up more than 10% for the year, and I know I did a tweet on it, so maybe I'll just read my tweet. We'll get there this way. We'll get there one way or another. Here we go. Yesterday, so this would be Monday, was the 218th trading day of the year. S&P is up 14.9% for the year as of Monday, the 218th day of the year. When you're up at least 10% as of day 218, like we were. Sonu, I found 33 times. This was the 33rd. So I guess 32 times. No, it is 30. This is the 34th time. Nonetheless, a lot of times, let's just leave it at that. A lot of times you're up at least 10%. The rest of the year has been higher 91% of the time, up another 3.4% average, 3.7% median return. You're looking at years like 2021, 2019, 2017, 14, 13, 2009. I mean, those were all really good years with strong year-end rallies. The key concept, I'm going to turn it to you, the idea that, listen, there are a lot of people that have missed this rally. A lot of people have been bearish the whole way up. Now they manage money. They have to kind of jump in. They have to chase to show that we owned these things. We weren't just bearish the whole time. A year ago right now, we were in a bear market. We know that it was ugly. December was pretty ugly. It's almost the reverse happened last year, where you do see weakness in selling when you have a down year into the end of the year. Good news, we're not in that scenario now. There's a lot of reasons, fundamentals, and we just talked about a lot of them. But just sometimes you can have a chase into the end of the year when you're up a good deal. You want to build on that or anything else, why we're going to have the continued strength in the end of the year?
No, it's an important point, right? Like, you don't, like, sometimes everyone's looking for a catalyst. Like, oh, what's a catalyst that could drive a year-end rally? And, like, having looked at your data and a lot of other stuff, like, you don't really need a catalyst, right? These things can happen because people are positioned the wrong way. and they want to, position the right way going into the year end. They don't want performance to look bad. So they start buying things that are going up. What usually goes up at the end of the year? Well, equities, stocks go up at the end of the year. But this time, I think the added, there is a catalyst, right? Look, the CPI report, the Fed, that's the catalyst, right? If you're look at the 10-year yield today, right?
Yes.
3 weeks ago, the 10-year interest rate for treasuries was at 5%. It's at 4.45 right now, right? And we saw, Ryan, as you mentioned,
4.45 down 18 basis points.
Yeah.
Yeah.
Stocks were down in August, September, October. Again, hindsight's 2020. There's Monday morning quarterbacking. It's hard to predict what will happen. Looking back and say, oh, stocks went down because interest rates are going up. But I think that's fair, right? Markets didn't like higher rates, especially small caps for the reasons you mentioned, because they take on a lot of floating rate debt. But now rates are coming down. Rates are coming down. I think that's a catalyst.
I'll just chime in. I mean, we had incredible amounts of negativity when we went into a correction, right? The S&P, after literally the best first 7 months to a year since 1997, stocks were down 3 months in a row, had a 10% correction. Yes, we didn't quite think we'd be in a 10% correction. Yes, October was a little worse than we expected. The terrible war that took place, there are some different factors that pushed that, but we still said, there's a lot of negativity. In some cases, more negativity than we saw during the pandemic. I mean, that's just crazy, but it's where we were with things. And on this very podcast, we kept saying, listen, we need something, some good news, some catalyst that can spark us. I think it's also the realization, hey, earnings were solid. Earnings next year should be up, this is estimates, right? Up 10, 11% or so, maybe a little bit better if the economy does better. The realization that there's no recession coming. We've been lied to. We've been bamboozled, whatever words you want to use. We were promised circuit breakers. We were promised quad 4. We were promised yield curve inversions. We were promised LEIs negative for 19 months. If you've listened to this podcast, we've been saying don't listen to that stuff. The other things that are happening are positives. And now here we are with the market that's rallying.
Yeah, don't Google any of that stuff.
Anyway, I gets me upset sometimes.
I'm laughing at quad
exactly.
4.
It's just what it is.
But let's just level set. Okay, so going into next year, right? Like you just mentioned, earnings are expected to go up 10, 11%. Let's talk about the economy just to round it all up, right? What do we expect for the economy going forward, right? Look, if the 10-year yield, the first thing I think about when I see 10-year yields, interest rates down from 5% to below 4.50, what does that do to mortgage rates? That pulls mortgage rates down too, right? If mortgage rates come down, yes, it's going to be higher than, I got a mortgage at to 3%. I think that world is over, right? But if it comes down to 6.5%, 7%, I think it suddenly unlock a lot of housing activity, and boom, we are off to the races again next year. I think that's just
well said, and and we've talked about this before, but the important concept is stock market tends to lead the economy. You look back at major market lows going back 50 years, equity prices tend to go higher before earnings turn higher, before GDP turns higher, before employment turns higher. It's never that simple, but we've seen this throughout history, and now we've got a market that's starting to rally again, potentially again sniffing out a better economy, and like you just said, maybe unlocking a lot of the just devastation that we've seen in the housing market overall. And again, that's just some positive things. So we probably want to wrap things up here, Sonu. We had another, I don't even know what in the heck it was. Would you call it a downgrade? It was more of a warning. Moody's cut their outlook on the U.S. credit, but they left the AAA rating. So honest to goodness, I'm not sure what that means. Remember, S&P downgraded the U.S. to AA plus 2011, and Fitch came out, I think it was earlier this year, and early August, and downgraded to AA plus as well. So again, Moody's is still AAA, but they just went from negative to stable, and they citing the deficit and some of the well-known worries and concerns. Honestly, some of the reasons Fitch did what they did, they're citing the same things. It almost seemed like nobody cared. It came out on a Friday afternoon. I remember that because early August 2011, that first downgrade was a Friday afternoon. Thought they'd sneak it by everybody. Then the market fell 19% the next couple of days in August 11. If some of you remember those days, that was a lot of fun. This time, it's like everyone said, "Nah, we're not worried." I mean, and honestly, when Fitch did it in August, rates did go higher for a couple of months. I don't know if it was because of the Fitch downgrade, but that was one of the arguments. Maybe, higher debt, lower rated debt, interest rates should go up. Interest rates are crashing right now as we talked about. You want to build on Moody's, whatever they said? Yeah.
Yeah, I mean, on the face of it, yes, is it great that Washington's struggling to pass a budget to fund spending at even current levels? Forget, thinking about the future. Yeah, no, that's not great. I mean, and then you think, okay, if this were a company, we put it on negative watch, right? That's what Fitch did, literally. They put the U.S. on negative watch. But look, governments are not businesses, right? Governments are not in the business of making a profit or anything like that, right? Look at 10-year treasuries, right? They were 10-year treasury interest rates are at 5%. Just 3 weeks back, everyone is saying, oh my God, the deficit's too high, deficit's too high. The deficit's still probably too high, right? But interest rates have gone down to 4.5%. Sure. Does that mean nobody cares about the deficit anymore? No. Like, I think there's too many, people are drawing too many connections between one piece of data here, one piece of data there. But, and saying, oh, interest rates are too high, the government's got to cut spending. Yes, maybe the government does have to cut spending. That's a whole other thing. I won't even get into that. But what happens at interest rates, I think that has more to do with inflation and the Fed.
Yeah, and I've said it like this. I mean, if the marketplaces were truly worried, and I'm not a fan of all the debt, I want to be very clear, but if the marketplace was really worried about all the debt, the deficits, and the spending in the U.S., it's hard for me to think the U.S. dollar would be stronger. I mean, dollar was really strong last year. Dollar's been strong the last couple of months, maybe rolling over a little bit. But, you'd have a massively weaker dollar, which in theory should be massively inflationary. What have we just talked about? Some reasons for disinflation that are coming out there. So, and credit spreads. I mean, you and I, listen, on our team, we manage real money for our Carson partners. We came into this year overweight equities. As you listen to this podcast, in March, we added a little bit of equity risk when everyone was telling us the regional bank crisis is going to spiral out of control. You know what we did? Back in October, we added a little bit of equity risk on the market weakness when everybody's telling us how the end of the world was coming. There's a lot of reasons. I say I like to follow the credit markets. We didn't see stress in the credit markets in March. We didn't see major stress in the credit markets in October. Was there a little bit? Sure, there's a little bit. It wasn't anywhere near the worry that you would have seen if the wheels are about to fall off. And again, looking back, adding a little bit of equity risk those 2 times was probably a pretty good decision. And people laughed at us. They were mad at us. They hated us for it. It felt like on social media for being remotely bullish and looking at the positives that are out there. But now we're looking at a year that's pretty darn good with participation now coming in with small and mid caps. With the fact the Fed is done, maybe we're going to cut with an economy again that is seeing 4% annualized productivity the last 2 quarters. Those are all positives as we head into next year. Sonu, I'll get off my soapbox. Anything you want to finish things up with on episode 60 here?
No, I think that's a good place to finish. You talk about credit spreads, right? And basically, it says that markets are not worried about companies paying them back. Like if you lend money to a company, markets are right now, investors are not worried about it. We've just had Dan Iverson, the CIO, the group CIO at PIMCO, on the podcast 3 weeks back. He said the same thing, right? PIMCO is the bond market for, all practical purposes, right?
That's true.
And if the CIO at PIMCO is saying he's not really worried about defaults a lot, I'll take him at his word. And, here we are. The economy is doing good. Fed's inflation's coming back. Inflation's not just off the boil. It's probably headed back to the Fed's target, which means we can forget any more rate hikes. We can plan for rate cuts, right? I think that's huge.
Yeah, well, we'll see where it all goes, but obviously we've been optimistic that, yes, it wasn't fun when we had that 3-month losing streak and the 10% correction, more in some other areas. But again, we thought there's opportunities out there, and fortunately, it looks like a lot of those are playing out. So with all of that, we're going to sign off here as I'm sitting in Spokane, Washington, and Sonu is sitting in Chicago there with Why the Fed is Done, Chicago. Episode number 60 of the Carson's Facts versus Feelings podcast is in the book. We'll see everybody next week. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk.
including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.